Financial insights I wish I had known in my 20s.
Personal finance is an area of much anguish for many people. Sadly, there is not much basic education in this area. Why do 70% of lottery winners go broke in just a few years after their big win? How can some people be going broke on an income of $500,000 a year? This video will attempt to answer these questions and provide some tips to help develop your financial IQ.
Insight 1.
Inflow, outflow. It's not rocket science. If you spend more than you make, you create debt. The problem is that it gets complicated with all the companies trying to reach into your pocket. Leasing options are getting more and more creative at taking your future dollars. Even our own government plays games with the interest rate to encourage you to spend money you don't have. It comes down to affordability. What is affordable for one person is not necessarily affordable for another. Career choice will help you determine inflow, but regardless, spending money you have not yet earned is a fast track to personal bankruptcy. Bottom line, if your inflow is larger than your outflow, you create savings. If your inflow is smaller than your outflow, you create debt.
Insight 2. Net worth. The simple calculation of net worth is a great way of determining your financial well-being. On a spreadsheet, list your assets, things that have a dollar value if you were to sell them, in one column, and your liabilities, the money you owe, mortgage, bank loans, credit card debt, taxes due, etc. Subtract the second column from the first column, and if the number is negative, you have some work to do. If it is positive, you're on the right track, and growing that number is a great way to get ready for retirement. Doing this calculation a couple of times per year will help track your progress. It is like a snowball effect. You just need to get it rolling. Bottom line, slow and steady, and there is no race. Insight 3. Time versus money. The real currency of life is time. Building up your net worth can allow you to work less and play more. Passive income is money you earn without your time tied to generating it. Real estate investments and dividend-paying stocks are examples of assets that can generate passive income. Bottom line, the more passive income, the more time you have to do other things. Insight 4. Good debt versus bad debt. Consumer debt is borrowing future dollars to improve your current lifestyle. I consider this bad debt and goes back to affordability. If you can't afford it, don't buy it. The worst form of debt is high-interest debt, like credit card debt. U.S. credit card companies offer students a card that has a super low 2.5% interest on the outstanding balance until they turn 25. Then it jumps to just under 20%. Left unpaid, that would double the amount due in just over 3.5 years. Wow, talk about sending a bad message to young adults. On the other hand, debt is often required to buy certain investments. As long as the asset generates a bigger after-tax return than your interest cost, you are ahead of the game. Real estate is a good example of an asset that most people buy with debt financing. People often borrow money to buy a business or shares in a company. In any case, too much leverage, debt versus asset value, increases the risk of losing it all. Bottom line, use debt to create wealth, not improve lifestyle. Insight 5. Taxes. Taxes are a reality and need to be factored into outflow. There are ways to legally pay less in tax. Examples include Registered Retirement Savings Plan, RRSP, Tax-Free Savings Account, TFSA, and the increased value of your principal residence are a few ways to reduce the income tax you pay while increasing your wealth. Bottom line, look into what options best suits your investment strategy and income level. Insight 6. Banking. Banks are necessary, but you need to pay attention. They represent some of the most successful companies in Canada for a reason. Fees can seem insignificant, but with multiple accounts and over time they add up. Banks will often give you a better deal on mortgage rates and refinancing fees if you grind them a little. With small business, they tend to try to cover their exposure several times over. It is always a good idea to shop around, even if you don't end up moving banks. It gives you a better bargaining position. Bottom line, Pay attention to what banking is costing you and ask for a better deal. Insight 7. Stocks. Sadly, the stock market has been a tough place to generate wealth. There is a wide range in risk when considering an investment in the stock market. There are stocks that are highly speculative, often newer businesses, and called penny stock because they tend to trade well below $1 per share. On the other end of the scale, there are well-established companies that have much less risk but often lower returns. The stock market, in my opinion, has become like a big gambling game with investors looking for a quick return. Option trading, effectively betting on what a stock is going to do, makes it even more volatile. Having said that, it still represents a great opportunity for people to generate passive income. Warren Buffett continues to prosper decade after decade with a long-term, value-based investment strategy. One of Buffett's best quotes is, "Risk comes from not knowing what you are doing." Bottom line, educate yourself before committing hard-earned dollars to the stock market. Insight 8. Real estate. This is easily my favorite investment as it is real. Real estate is one of the few things that you can't make more of. Location, location, location has long been 3 rules of real estate investing. And while hard to argue against them, there is an underlying principle that is crucial to understand. Supply and demand. Property is only worth what someone will pay you for it, therefore property in good locations tends to be a better investment than outliers. One downside to real estate is the time it takes to manage it. Property managers can take care of all aspects for a fee. Fortunately, there are real estate-based investments called real estate investment trusts, REIT, that are like buying shares in a company but are based on real estate. Rich Dad, Poor Dad is a good read if you want to learn more about this investment option. Bottom line, a large percentage of the world's wealthiest people have made their fortune investing in real estate. That concludes the 8 insights, and I encourage you to dig deeper into any of them that you feel could help you build wealth and avoid the pain and suffering that so many people endure when they mismanage their finances. Remember, slow and steady. This video has been generated with the intention of helping educate people about money. There is no profit of any kind or sales pitch coming your way. I hope you found it worth watching, and if you did, please feel free to pass it along to anyone that might find it interesting. Created by David Newton, tree planter, entrepreneur, real estate investor.